Candlestick patterns have captivated traders for centuries, finding their roots in Japan, where they were used as early. Today, basic single candlestick patterns play a crucial role for traders, serving as the building blocks for more complex chart analysis. Each pattern, represented by a single candle, conveys significant information about price movements within a trading day. Whether it signifies bullish or bearish trends, the interpretation of these patterns provides traders with insights that guide their trading decisions. As we delve into the world of basic single candlestick patterns, it is essential to grasp their relevance in today's trading environment. They are not just historical artifacts, but practical tools that, when mastered, can greatly enhance a trader's ability to read market trends and make informed decisions. From the simple yet telling formation of a single candle to the complex narratives told by sequences of patterns, the study of candlestick patterns is an invaluable asset for anyone looking to navigate the financial markets with confidence. Basic single candlestick patterns are fundamental to understanding market sentiment and making informed trading decisions. These patterns, formed by the price action of a security within a single day, may look simple, yet they offer powerful insights into market psychology. For instance, the doji pattern is shaped like a cross or plus sign, with the opening and closing prices nearly identical. It signals indecision in the market, suggesting a balance between supply and demand. This pattern can be a precursor to a potential reversal or continuation of the current trend, depending on the context in which it appears. The marubozu is quite the contrast, featuring a large body with little to no shadows extending from the top or bottom. A white marubozu with the close at the high of the day signifies strong buying interest, whereas a black marubozu closing at the low indicates strong selling pressure. The hammer and inverted hammer are indicative of potential reversals. The hammer, with a small body at the top and a long lower shadow, suggests that despite selling pressure during the day, buyers managed to close the session near the opening price. This pattern is seen as a sign of possible bullish reversal. Conversely, the inverted hammer, which also signals a potential bullish reversal, has a small body at the lower end with a long upper shadow, indicating that buyers attempted to push the price up but faced resistance. Each of these patterns provides a glimpse into the underlying market dynamics and the sentiment among buyers and sellers. Though simple in appearance, they are foundational for those learning to interpret market movements and make strategic trading choices. Basic single candlestick patterns are identified through a combination of their visual characteristics, including shape, size, color, and wick length. These elements come together to signal potential market movements to traders. Shape and size. The body of the candlestick represents the difference between the opening and closing prices for the period. A long body indicates strong buying or selling pressure, whereas a short body suggests a more indecisive market. For instance, a long green or white body signifies strong buying interest, and a long red or black body points to notable selling pressure. Color. The color of the candlestick body helps to quickly convey market sentiment. Traditionally, a green or white candlestick denotes a closing price higher than the opening price, signaling bullish sentiment. Conversely, a red or black candlestick indicates a closing price lower than the opening price, showing bearish sentiment. Wick length. The wicks or shadows extend from the top and bottom of the body, showing the highest and lowest prices reached during the period. A long upper wick indicates that buyers pushed the price up, but sellers eventually forced it down, while a long lower wick suggests sellers lowered the price, but buyers lifted it by the period's close. The importance of context cannot be overstated. The trend preceding the pattern plays a critical role in its interpretation. For example, a bullish candlestick pattern may carry more weight if it appears after a prolonged downtrend, suggesting a potential market reversal. Imagine a chart showing a series of red or black candlesticks indicating a downtrend. Suddenly, a long green or white candlestick appears, potentially signaling a shift in market sentiment. The surrounding downtrend enhances the significance of this bullish pattern, suggesting that bears may be losing control to the bulls. In summary, identifying basic single candlestick patterns involves analyzing the candlestick's shape, size, color, and wick length within the context of the market's preceding trend. This analysis provides insights into market sentiment, helping traders to make more informed decisions. Basic single candlestick patterns provide insights into market sentiment by reflecting the collective actions and psychology of traders. Here, we'll explore some of these patterns and what they reveal about the balance between buyers and sellers. The hammer pattern, characterized by a small body at the upper end and a long lower shadow, suggests that although sellers drove the prices down during the session, buyers were able to push it back up, closing near the opening price. This pattern indicates a potential reversal of a downward trend as it shows buyers are gaining ground. Conversely, the shooting star pattern, which has a small body at the lower end and a long upper shadow, signals that buyers initially pushed the prices up, but sellers managed to pull it down to close near the opening price. It reflects a potential reversal of an upward trend, signaling seller dominance. The doji pattern, where the candlestick has an almost equal open and close price, signifies indecision in the market. With its small body, it illustrates that neither buyers nor sellers could gain the upper hand, suggesting a possible change in market direction or continued consolidation based on preceding trends. Each of these patterns, through the eyes of a trader, acts as a psychological cornerstone. For instance, spotting a hammer after a series of declines might encourage a trader to anticipate a turnaround, inciting a more bullish outlook. Conversely, a shooting star after a prolonged rally can invoke fear of an impending drop, prompting a cautious or bearish adjustment. These patterns serve as a vivid narrative of the tug-of-war between optimism and pessimism, unveiling the underlying currents of market sentiment. By recognizing these signals, traders and investors get a snapshot of the emotional state of the market, guiding them in adjusting their strategies in anticipation of future movements. In the study of basic single candlestick patterns on financial charts, we can categorize these patterns into two main types: those that suggest a trend continuation and those that indicate a potential trend reversal. Continuation patterns signal that the current trend is likely to persist. For example, a small candlestick body following a large candlestick in the direction of the trend can be considered a continuation pattern. It suggests that despite the brief pause, the existing trend is strong and likely to continue. On the other hand, reversal patterns are those that signal a potential change in the direction of the market trend. A common example is a long wick on the opposite side of the prevailing trend, indicating that the market is testing but rejecting an opposing direction, potentially foretelling a reversal. However, the interpretation of these patterns can significantly vary depending on the specific market conditions and the surrounding candle formations. For instance, a pattern that generally signals trend continuation may be seen as a reversal indication if it occurs at a major resistance level or after an extended trend. Similarly, the presence of other confirmatory patterns around the single candlestick can either strengthen or weaken the original signal. Understanding the context, including market sentiment and technical indicators, is crucial. A comprehensive analysis, considering both the individual pattern and its broader context, leads to more informed trading and investment decisions. When delving into the realm of basic single candlestick patterns, it's crucial to recognize that confirmation through additional indicators is key to validating these patterns. Trade volume, market trends, and complementary technical indicators are pivotal in bolstering the confidence in these candlestick signals. Let's carefully unpack these concepts to understand their significance. Trade volume plays an instrumental role in confirming candlestick patterns. A sudden surge in volume accompanying a pattern can denote strong market sentiment, enhancing the reliability of the signal. For instance, a bullish candlestick pattern paired with a high trade volume suggests a robust buying interest, thereby increasing the chances of an upward trend continuation. Market trends serve as the backdrop against which candlestick patterns unfold. Understanding the prevailing trend is vital because candlestick patterns tend to be more reliable when they align with the overall market direction. A pattern that emerges in sync with the trend is considered to have a higher predictive value compared to one that goes against the grain of the trend. Complementary technical indicators such as moving averages, relative strength index RSI, and MACD moving average convergence divergence further cement the validity of candlestick patterns. These indicators can help identify potential support or resistance levels, momentum shifts, and the overall health of the trend. For example, a bullish candlestick pattern emerging near a key moving average support might be seen as a strong buy signal, especially if it is accompanied by a positive divergence in the RSI or MACD. The importance of confirmation cannot be understated as it helps to sidestep false signals, which are anomalies that could lead to erroneous trading decisions. By waiting for additional indicators to corroborate the signal presented by a candlestick pattern, traders can enhance their trading strategies' effectiveness and mitigate risk. This prudent approach ensures that decisions are not based on isolated patterns, but are supported by a confluence of evidence, leading to more informed and potentially profitable trading moves. Basic single candlestick patterns are foundational tools used by traders and investors to gain insights into market sentiments and potential price movements. These patterns, formed by the price movements within a single trading session, can offer valuable information about the immediate direction of the market. However, their reliability must be evaluated in the context of historical data and the broader market conditions. Historically, basic single candlestick patterns have been used to highlight moments of potential reversal or continuation in the market. For example, a pattern like the hammer indicates possible bullish reversal after a downtrend, signaling to traders that buying interest may be increasing. Meanwhile, a shooting star pattern suggests a bearish reversal during an uptrend, hinting at growing selling pressure. When assessing the reliability of these patterns, it's crucial to consider the volume of trading activity accompanying the pattern formation. A high volume of trades can add credibility to the signal, indicating stronger consensus among market participants regarding future price movements. Nonetheless, it is essential to acknowledge that these patterns are not foolproof predictors of market movements. The financial markets are influenced by a complex web of factors, including economic indicators, geopolitical events, and market sentiment. Therefore, while basic single candlestick patterns provide useful insights, they should be used in conjunction with other analysis techniques and market indicators for a more comprehensive assessment. In summary, basic single candlestick patterns are useful tools that, when analyzed within the proper context and supported by additional market analysis, can offer valuable insights into potential market movements. However, traders and investors should be aware of their limitations and the fact that no analytical method can guarantee future market directions with absolute certainty. Basic single candlestick patterns, such as doji, hammer, or engulfing patterns, can be powerful indicators of potential market reversals or continuations when used in isolation. However, their predictive accuracy improves substantially when they are combined with other technical analysis tools like the Relative Strength Index, RSI, Moving Average Convergence, Divergence, MACD, and Moving Averages. Here are some ways to combine these tools with basic single candlestick patterns for a more comprehensive analysis, along with examples of how these combinations can be applied in real trading scenarios. Combining with the Relative Strength Index, RSI. The RSI is a momentum oscillator that measures the speed and change of price movements on a scale of 0 to 100. When you spot a hammer pattern, which typically indicates a potential bullish reversal at a time when the RSI is below 30, this may confirm that the asset is oversold and a reversal is likely. For instance, if a trader notices a hammer pattern on a stock chart while the RSI is at 25, it might be a good opportunity to buy, anticipating a price increase. Integrating with moving average convergence, divergence, MACD. The MACD is used to identify changes in the momentum, direction, and duration of a trend in a stock's price. A bullish engulfing pattern indicating a potential upward trend when combined with a MACD crossover from below the signal line provides a stronger signal for the traders. For example, if a bullish engulfing pattern forms and soon after the MACD line crosses above the signal line, it could be a sign for traders to consider entering a long position, expecting the uptrend to continue. Utilizing moving averages. Moving averages smooth out price data to identify the trend direction over a specific period. A doji pattern, which suggests indecision in the market, followed by the price moving above a key moving average like the 50-day or 200-day moving average, could indicate the end of a downtrend and the beginning of an uptrend. Imagine a scenario where a doji pattern forms and immediately after, the stock price rises above the 200-day moving average. This could be interpreted as a signal to buy the stock, as it may indicate the start of an upward trend. In real trading scenarios, these combinations provide traders with more context about market conditions, allowing them to make more informed decisions. It is crucial, however, to remember that no indicator or pattern is foolproof. Traders should always consider multiple indicators and conduct a thorough analysis before making any trading decisions. Traders often encounter common pitfalls and misconceptions when interpreting basic single candlestick patterns. One major mistake is attributing too much significance to a single candlestick without considering the larger market context. For example, a single bullish candlestick in a downtrend does not necessarily mean a reversal. Traders may also misinterpret the patterns by not taking into account the volume that accompanies the formation of the candlestick, which can greatly influence its significance. Another common error is the lack of patience, leading traders to make premature decisions based on incomplete patterns. Waiting for the candlestick to fully form and confirm the pattern is crucial for accurate interpretation. Additionally, an over-reliance on candlestick patterns alone without integrating other analysis tools can lead to skewed trading decisions. Candlestick patterns should be used in conjunction with other technical indicators and fundamental analysis to validate trading signals. The importance of experience and continuous learning in correctly interpreting candlestick patterns cannot be overstated. The nuances of these patterns and their implications on market movements become clearer with time and practice. Engaging in regular analysis, keeping abreast of market trends, and reflecting on unsuccessful trades are vital steps in honing one's ability to effectively use candlestick patterns. The financial markets are dynamic, and continuous learning enables traders to adapt their strategies to changing market conditions, ultimately enhancing their trading proficiency. Basic single candlestick patterns provide a simple yet effective way to make informed trading decisions by highlighting potential reversals or continuations in market trends. These patterns, characterized by just one candlestick, can serve as signals to set entry and exit points in the trading market. Here is a concise guide on how to use these patterns, along with tips on risk management and the importance of having a trading plan. Identifying the pattern is the first step. A single candlestick with a long shadow and small body, for example, can indicate reversal. A bullish hammer, characterized by a long lower shadow, signals that sellers drove the prices down, but buyers were able to push it back up, indicating potential upward momentum. Conversely, a shooting star, which appears after an uptrend with a long upper shadow, suggests a downturn might be imminent. Setting entry points involves waiting for the confirmation of a pattern. After spotting a bullish hammer, for example, consider entering a buy trade if the next candlestick continues to show upward movement. This confirms the momentum shift signaled by the hammer. For exit points and stop-loss orders, looking at the patterns high and low can be instructive. If you enter a trade based on a bullish hammer, placing a stop-loss order just below the hammer's low minimizes potential losses if the market moves against you. As for taking profits, observing resistance levels or setting a target price based on your risk-reward ratio can guide when to exit a trade. Risk management is critical. Even with a confirmed pattern, the market can move unexpectedly. This is why using stop-loss orders and not risking more than a small percentage of your trading capital on a single trade is essential. Diversifying your trades can also reduce risk. Finally, having a well-thought-out trading plan that outlines your strategy, including how you will identify patterns, set entry and exit points, and manage your risk, is of utmost importance. A trading plan helps you trade systematically and avoid emotional decision-making, which can lead to losses. By understanding and applying basic single candlestick patterns within a structured trading plan and adhering to strict risk management rules, traders can improve their chances of success in the financial markets. In the realm of trading, basic single candlestick patterns serve as the foundation for understanding market sentiment and potential price movements. However, there are variations and similar patterns that traders should be aware of to deepen their analysis and enhance decision making. Let us introduce some of these variations and explain their unique applications in trading. First, consider the hammer and inverted hammer, both of which signal potential reversals. The hammer, characterized by a small body at the upper end and a long lower shadow, indicates buyers are regaining control after a downtrend. In contrast, the inverted hammer, with its small body at the lower end and a long upper shadow, suggests a possible upside reversal after a downtrend, albeit with less conviction than the hammer. Another variation is found between the doji and the long-legged doji. A doji, where the opening and closing prices are virtually identical, exemplifies market indecision. The long-legged doji, distinguished by its long upper and lower shadows, amplifies this indecision, showing a greater struggle between buyers and sellers. The bullish engulfing and bearish engulfing patterns also offer insights into market dynamics. A bullish engulfing pattern, where a small bearish candle is followed by a large bullish candle completely engulfing the first, indicates a strong buying pressure and potential upward movement. Conversely, a bearish engulfing pattern signals the opposite, suggesting sellers have overtaken buyers and a downtrend could be imminent. Lastly, the shooting star and its counterpart, the hanging man, both feature a small body at the lower end with a long upper shadow, but their implications vary based on preceding trends. A shooting star appears after an uptrend, warning of a potential reversal downwards. The hanging man, however, occurs after a downtrend and hints at a possible upside reversal. By examining chart examples, traders can witness these variations in action, seeing how the hammer signals a recovery trend after a downturn, or how the engulfing patterns can forecast significant shifts in market direction. Understanding these variations allows traders to better anticipate future movements, applying these insights to devise more nuanced and effective trading strategies.